Most traders draw supply and demand zones completely wrong, and then wonder why price blows straight through them every single time. In this video, I'm going to show you exactly how to identify and draw them correctly. You've tried supply and demand before. Place your entry at the zone and watch price push straight through your level like it wasn't even there. We've all been there, marking up zones with confidence only to get stopped out before price moves in the right direction. I went through the exact same frustration in my early trading. It wasn't until I understood what a zone actually represents that everything changed. 6 years later, this is still the foundation of every trade I take. So in this video, I'm going to walk you through exactly how I identify and draw these zones so that we can stop guessing and start trading levels that actually hold. By the end of this video, you know exactly what makes a zone valid, how to draw it correctly, and how to tell the difference between a zone worth trading and one worth ignoring. Let's get into it. If you find this video useful, make sure you subscribe. I post weekly videos breaking down the exact concepts I use to trade the markets every day. First, we need to understand what a supply and demand zone actually represents. So as we know, the big banks move price, okay? So it's the institutional traders who are actually moving this market. Now, how they do so is they build their positions over time. So they would typically build it in a range. So what happens is if a bank wants to buy a contract, okay, so buy a asset, then they would do so by buying into retail traders who are still selling, right? Because they need to put a large position on, so they need a lot of selling orders so that they can buy into that and get their buy orders filled, right? So what a demand zone is it is a range, right? So price would typically form a range and then we'll have a large drive to the upside. And what's left in its wake is a demand zone, okay? So demand zone is simply a zone that is seen as a good level to buy from in the past, right? Because the banks saw this level and they thought it was a good time to buy. So they put on their large buy positions and they took price higher. Now, since it was seen as a good level to buy from in the past, if price were to pull back and retest our zone, then it can be seen as a good level to buy from in the future. Therefore, we can buy from demand. And a supply zone is simply the opposite. So the banks distribute their positions. They do this by selling into the retail traders who are still buying. Okay, they absorb the buying orders, so the buying pressure from the retail traders, so they can put their sell orders on. Now this again typically occurs in a range, and then once they have their position on, price has a strong drive to the downside. The supply zone is left behind, right? And a supply zone can be seen as a good level to sell from in the past, okay? Because there were a lot of institutional traders selling at this level. Therefore, if price were to return to the supply zone and retest it, then it can be seen as a good level to sell from in the future. So we can also sell from the supply zone. Now, a supply and demand zone in the real markets would look something like this. So how traders typically mark supply and demand zones is they use the last down candle before the up move as the demand zone. So it would be this candle right here. And they use the last up candle before the down move as a supply zone, which would be this candle right here. Now, to me, that does not make much sense. Okay, so how I mark supply and demand is I simply use the last candle before the push away. Okay, so this is the last consolidating candle, right? We can see it has a wick on either side. This is the last point where the banks were essentially accumulating their buy position before they took price higher, okay, before the drive to the upside. Now, this is seen as my demand zone. And a supply zone is simply the opposite. So it is the last candle before the drive down, okay? So again, it's typically a consolidating candle. We have a wick on either side before the push down, right? And this does not matter what color the candle is, okay? So the candle can be a bullish candle, a bearish candle, it does not matter. It is simply the last candle before the large push away. And the logic here is the same. So a demand zone is seen as a good level to buy from in the past. Therefore, if price were to return to this level, then it can be seen as a good level to buy from in the future, and we can buy from this demand zone. And a supply zone is the same as a demand zone, just in the opposite direction. So it is seen as a good level to sell your asset from in the past. Therefore, If price were to return to this level, it can be seen as a good level to sell from in the future, and we too can sell from supply zones. Now you might be thinking, this looks no different from how I've been trading supply and demand already. And you'd be right, because on its own, supply and demand is not enough. Open any chart right now, and you'll see supply and demand zones everywhere. If you try to trade every single one of them, you wouldn't just underperform, you'd get destroyed. So the real question isn't how to draw zones, it's how to identify which zones are actually worth trading. That's exactly what I'm going to show you now. The two additional concepts I use to filter out the noise and find the highest probability zones on the chart, the ones most likely to produce a strong reaction. And those two concepts are market structure and imbalance. If you haven't watched my full market structure breakdown yet, I'd highly recommend doing that first. I'll link it in the card above, because understanding market structure is the foundation before everything else makes sense. Since we know we want to buy from demand and sell from supply, we can use this in context to structure. So how do we do that? Well, firstly, we need to map our structure. So clearly we can see price is trending higher, okay? It's making higher highs and higher lows. Therefore, if we know the market is moving higher, we want to be buying from demand zones, right? We do not want to be selling into this market or looking to sell from supply when the market is making higher highs and higher lows. So that is the first thing we need to consider when we are mapping supply and demand zones, is that we are looking to buy from demand, and we're only looking to buy when the market is trending higher, okay, when it is in an uptrend. And we want to sell from supply, and we only want to sell from supply when the market is in a downtrend. Now, it is not just any supply and demand we want to look to sell from, it is imbalanced supply and demand zones. So what is an imbalance? Well, to briefly cover what an imbalance is, we can take a look at the chart right here. So we have mapped out our demand zone, which is simply this last candle before the large drive to the upside. Now, what this drive to the upside has done, it has left an open gap in price. So an imbalance is simply this open price range left open right here. And how do we define this imbalance? Well, we can see that the wick of this candle right here does not meet the wick of this candle right here. Okay, so this has left open an imbalance range. And what this imbalance range tells us is that the buyers have actually stepped in at this level and aggressively taken price higher. Because a balanced market is when buyers and sellers are getting filled at the prices they want. Okay, so buyers are getting filled where they want to, sellers are getting filled where they want to, okay? However, an imbalance is after a large drive to the upside, which leaves one completely behind, okay? So this was a demand zone which drove price to the upside, leaving this imbalance range open, which is telling us that the buyers are in control, right? Now, how do we actually trade imbalance? Well, I put a lot of weight of imbalance being filled, okay? So when we see a gap like this, what I expect in the future is for price to return through this imbalance, fill the entire imbalance, and then retest our demand zone before trading higher. So we can put a lot of weight on this imbalance being filled, and this is what makes the supply and demand linked so closely to imbalances, right? Because beneath the imbalance, there will always be a supply or demand zone. Now, let's say instead of this wick driving over here, we actually push down all the way down to this point. Now this price range is no longer imbalanced. However, we can move our line right here. We can still see that we have this imbalance range over here. So even a small imbalance, okay, because we see this wick right here does not meet this wick right here. So we still have this minor imbalance left open. Now, even small imbalances, I put a lot of weight on them being filled. So I'm still expecting price to drive down at some point, fill the imbalance, retest the demand, and then looking for buys. Now let's say this wick actually drove straight down into our demand zone. Now we can clearly see that the wicks meet, okay? So this wick meets this wick at some point, okay? So at this point, when price retested the demand zone, it filled the imbalance. Now we have no longer imbalance left open. So this is a balanced market. It is a balanced market because price has retested our demand zone. At this point, we can now consider the imbalance filled, right? So therefore, if price were to drive down into our demand zone, then we would not necessarily be looking to buy from here, right? Because the imbalance has been filled. At this point, the demand zone was already retested. Therefore, it is now lower probability that this demand zone is actually going to produce a meaningful reaction. Therefore, instead, I would rather wait for price to trade lower, and trade towards another imbalanced demand zone before looking for continuations to the upside. And this ties directly into how many touches in a demand zone or supply zone are valid. So once the imbalance is filled, that means a demand zone has been retested, right? Because an imbalance is always going to sit above a demand zone or below a supply zone. So therefore, this demand zone has been retested. Therefore, if price were to return to this demand zone and retest it for a second time, then the demand zone is becoming weak. And we do not want to be taking trades from a weak demand zone. We'd rather wait for a fresh level, okay, with a somewhere lower down, which has imbalance leading into it. Now, that does not mean a second retest cannot produce a reaction. This is possible and it does happen. However, we have to trade the probabilities, okay? So we have to take the highest probability trades. And in my experience, in my system, the highest probability trades come from imbalanced supply and demand. So imbalance alone is what separates high probability zones from average ones. I've done a dedicated deep dive on imbalance, which I'll link in the card above. Make sure you check that out after this one so that you have a better understanding of how imbalances work, because these two concepts work hand in hand. Continuing on from where we left off, we know we are in an uptrend, therefore we're looking to buy from demand. And it's not just any demand we're looking to buy from, we're looking to buy from imbalanced demand zones, right? Now let's say instead of price printing a new higher low and a new higher high, we actually push down and print a lower low. Now the trend has started to reverse from making higher highs and higher lows in an uptrend. It's our first sign that the uptrend has ended and that we are shifting into a downtrend. Therefore, we know when price is in a downtrend, we want to be looking to sell. And where do we want to look to sell from? Well, we look to sell from supply zones only. So we're no longer looking to buy from demand anymore, but we are shifting our focus to look for sells from supply. So we map out a supply zone, but we also know we don't just sell from any supply zone. We only look to sell from imbalanced supply zones. Therefore, we can look to take a short position from this supply zone to continue the downtrend. Now let's take what we've learned about supply and demand, market structure and imbalance, and go ahead and mark on the supply or demand zones within this trend. So as we can see, price is clearly making higher highs and higher lows, which we can clearly see by the breaks of structure. So since price is in an uptrend, we know that we'd be looking to buy from demand zones only. So we would just mark on the demand zones we see. We can clearly see we have this last candle before the push up, and this had imbalance leading into it. Price then retested our demand zone and pushed into a new high. And if we were to mark on our next demand zone, we have a demand zone right here, which is our last candle before this push up. And this has imbalance leading into it. Although it is a very small imbalance, we can clearly see there is still imbalance leading into it. Okay, price did not retest the zone at this point, but actually left an imbalance open. However, we can also see we have this demand zone, right? Because this demand zone also has imbalance leading into it. Now we are left with two demand zones. However, we know that we put a lot of weight on imbalance being filled, and we only look to take trades from the highest probability of zones. Therefore, we would not be looking to buy from the above zone. Although it has imbalance leading into it, there is a lower zone just beneath it that also has imbalance leading into it. So we are expecting the imbalance to be completely filled before taking price higher. And as we can see, price clearly trades through the higher zone and then fills the lower imbalance and retests the low zone before continuing higher. Continuing on, we clearly see we have this demand zone here. And this demand zone also has imbalance leading into it. And above it, similar to what we have just saw, we have this demand zone, which also has imbalance leading into it. Now again, exactly what we saw here, we have two demand zones, both with imbalance leading into it. We put a lot of weight on imbalances being filled. We only take trades from the highest probability zones. Therefore, we would not be looking to buy from the zone, but would actually be looking to buy from the lower zone. And now we can see price actually traded right through this demand zone, okay? Also breaking structure to the downside. Therefore, our uptrend has now started to shift into a downtrend. So what we would do is we would now be looking to sell. So if we were to quickly recap what we see here, we clearly see we have an uptrend. We're looking to buy from demand. We can see we had this demand zone, which was nicely retested, would have been a good trade. We then pushed up, made a new high, pullback. We had two demand zones. However, we only take the highest probability trades by looking for the imbalance to be filled first. And price retested this lower zone, filled the imbalance and took price higher. So this would have been a good trade as well. Then again, similar to the previous example, we had two demand zones. However, we put the weight on the imbalance being filled. So we're looking to take a trade from the lower zone. However, we can clearly see that this would not have worked, right? Now that is simply how it goes, okay? Not every supply and demand will hold. Even if you are trading in an uptrend, even if you are looking for imbalanced zones, it's not always guaranteed, right? So we can clearly see out of the three high probability zones, two of them would have produced very nice profitable trades and one would have given you a loss, okay? And that is just the nature of the game. It is the nature of trading probabilities. However, if you would think about it, these two wins would put a lot more profit in your pocket versus this one loss, okay? So that is where our money management comes in. We make sure that this one loss is not going to do any damage, well, minimal damage to our account, so that these two wins can, put the profit in our bank account and tilt the odds in our favor. Moving on to our next example, let's go and break down this market and mark on the supply and demand zones, again using imbalance and market structure as well. So looking at this market, we can clearly see price is breaking to the downside, okay, making lower lows and lower highs, which we can clearly see when marking on our breaks of structure. Now, since we know price is breaking to the downside, we know we are looking to sell from supply zones. We have our market structure, we're looking to sell from supply, but we need to pair our imbalance with the supply zones to find the highest probability zones to sell from. So we take a look at this trend. We can see there is no clear supply zones up here, okay? Price had a push down, but then wicked back and retested all these supply zones, retested here, retested here. So there's no reason to sell from any supply zones higher up. However, our first supply, which we can see has imbalance leading into it, would be this one right here. We have this indecision candle followed by a large drive to the downside. So our supply zone is our last candle, which is typically an indecision candle, before the large push down. And this has imbalance leading into it. Price in pullback retested our supply and started again to push to the downside. Now, after this push down, we can see we did also leave a supply zone right here. So this is again an indecision candle before a large drive to the downside. And this supply zone had imbalance leading into it. Now, this was quickly retested and then price sold off again, breaking structure to the downside. Once again, once price breaks structure to the downside, we can see it leaves open a supply zone, quite a clear supply zone. And the supply zone has imbalance leading into it right here. However, we can see price then actually goes and breaks through the supply zone and actually breaks structures to the upside as well. Now, the market has clearly shifted from making lower lows and lower highs in a downtrend to breaking into a new higher high, okay? So this is the first sign that the trend is about to reverse. And what we can do from here is simply look to continue on buying from demand, okay? So we'll no longer be looking to sell from supply at this point because price has told us that it's potentially going to move higher. And if we are going to break down our supply zones, we can clearly see we had three very clear high probability supply zones. Okay, so we're only looking for the supply zones that actually had imbalance leading into them. And we had again a nice trade from this one right here. We had a nice trade from this one right here. And then this one again was traded through. Okay, so we would have taken, in this case, also out of the three high probability supply zones that we were looking to sell from, we would have had one win here, another win here, and then we would have taken a loss here. So in the same way we saw in the previous example, this is just the nature of the game, right? Even if you do everything correctly, even if you mark the market structure, the imbalance supply or demand, we are still trading probabilities. Okay, so it is not always guaranteed, but we are trying to tilt the odds in our favor so that we give us the best chance to take the highest probability setups so that when we do win, we get a lot more in our bank account compared to when we lose. And that's how I identify and draw supply and demand zones. If this made sense to you and you want to see how it fits into a complete trading system, I've linked two things down below. My free mini course where I break down my full methodology at a surface level, and the MacFx Academy course for those ready to go all in and build a system that you can actually trust. Links are in the description, and I'll see you in the next one.